Welcome to Pioneer Mindset, a place where we challenge our mindset and address the discomfort in both business and life by finding clarity resulting in bold conviction. I'm your host, Garrett Ruskamp, fifth-generation farmer, husband, and father from rural Nebraska. Whether you're navigating frustration from past decisions or worry about the uncertainty you face today in your business, we're going to learn from our struggles and take on new challenges with a resilient mindset. Join me as I share my journey of struggles I faced in agriculture as a farmer and family man. I'm ready to dive into honest conversations to tackle the mindsets surrounding key issues that rural ag business owners face that will ultimately help you gain control, leading to a profitable and sustainable business. Let's adapt to Pioneer Mindset and get to it. Welcome back, everyone. For this week's episode, I want to dive back into the business side of things, and I want to talk about financing and the different forms of financing. Now, before you click on to the next podcast or just try to skip past this one, just hang tight because I think this can be pretty relevant within your operation if you are looking at possibly trying to basically farm next year and to purchase your inputs for next year, or within your business just trying to maintain some different expenses that come up throughout the year, operating expenses. This can be pretty relevant, especially as we get into the last quarter of 2024. We're starting to look at securing our financing for next year and our funding for next year so we can book our inputs. And that's essentially what this came down to for me, and why I was trying to think about this was I was in the tractor and I heard a commercial come across the radio for a local ag retailer advertising about booking their inputs for next year, chemicals and, different crop protections and different things like that. And one of the selling points that they had was using Deere Financial or like Rabobank or different financing options like that. And so I want to kind of talk about this and go through kind of what that looks like, the pros and the cons, and share my personal experience. Now, when it comes to especially using Deere Financial, and they got 0% financing, which is usually a super attractive in a high interest rate environment like we are currently in. But there's different things that we need to weigh there other than just rushing in there, booking everything through them, using that 0%. I'm using quotations here since you can't see that, but using some of those different financing options. So I wanted to kind of share my experience with this because, truth be told, we've done this. We've used some of these different options through our local ag retailer and tried to go that route. So I kind of wanted to share my experience on that. So we used it for chemicals and some different crop protection products. And so you go ahead, and the way it worked for us, this is going to be different through each different retailer. But the way that it worked for us was essentially we put money down so we could lock in the best prices for these different crop protections, chemicals, whatever that be. So we put some money down so we could lock in those prices, those early discount prices. But then it was a couple months later when you can actually go ahead and apply for that Deere Financial and go ahead and get some of that put on Deere Financial. And the thing about this is we're gonna go ahead and put down this money, but then we're gonna come back later. We're gonna put it all on Deere Financial. It's all gonna go on there. Well, depending on what products that you're booking that you decide to use for next year, some of those apply and some of those have different, basically special terms. So it could be through Bayer, could be through Valiant, could be through Corteva, BASF, Brandt, all the different companies out there. And could be just each one is just a little bit different. Each one has different lengths of financing and different rates. And it just sounds so easy. Well, it's got 0% financing on all these. Just put it all there and we'll set it and forget it sort of thing. And so that's the one thing that I would say is it was definitely easy to forget about. And I myself, I feel like we operate at a pretty high level, and I knew that I had these things, but it's kind of easy to forget that they're there. And it might be kind of easy to forget how much that you actually have out there on Deere Financial, when it's due, what the actual special terms and the rates are, and things like that. And so that was my experiences. And with Deere Financial, if any of you are familiar with it or used it, it can be a little bit complicating as to how those statements come across. Especially for us, we've got Deere equipment, so we use Deere Financial at our Deere local dealer, and as for financing some of the different, basically repairs and parts and different things like that. And so it can be a little bit confusing when you got these different, basically, categories that are all kind of thrown into one account. And to manage it all, it definitely takes a high level of management to do that. And so that's just kind of my experience with all that. And it felt like it was kind of confusing as we went about this process. And so I want to talk about some of the pros and cons that I see, especially as one that has used this, some of the pros and cons, but also one from the pioneer farmer standpoint and looking at what other people have done in their businesses and some of the things that come about from using these different financing options. So to kind of dive into this, I'd say some of the pros are obviously you're going to save on interest. Well, we need to figure out exactly how much that is because yes, it says 0%, but sometimes you've got some of those different, like I said, when you're financing that, it's not everything goes on John Deere Financial and poof, it's gone, but you've got actually different companies that finance differently. And some of those, it might be 0%, but it might only be for 6 months. And then some of those are 0% for 10 months, 12 months, basically the operating season. And then some of those are actually maybe 3% in some of these high interest rate environments. There is maybe it's 3% after 6 months. And so there's different special terms there that you got to keep an eye on. But going back to saving interest, well, let's figure out how much. So I'm going to run kind of a bit of an example here that I threw together just for you to kind of put some numbers here together. And so for just a 1,000-acre operation, now if you farm 2,000, you can basically double these numbers. If you farm 500, you can cut them in half and vice versa. So for a 1,000-acre operation, say you've got 500 acres of corn, 500 acres of soybeans. So for corn, I'm going to estimate $40 per acre. That's kind of a 2-pass system, your pre's and your post, and that's going to be roughly $40 an acre. And so at 500 acres, that is $20,000 just for corn. And for soybeans, I'm going to estimate roughly $60 per acre. Once again, that's 2-pass system. You got your pre's and you got your post. At 500 acres, that is going to be about $30,000. Now, I'm also going to throw in there some fungicides, some maybe different foliar applications, roughly just estimating an additional $20,000 there for that. And that could be all personal, all relative to your situation and what you typically do. And it also could depend on if you're using any sort of generics. For us, we tend to use some name brand products just so we can get some of the services that we need. There, we get to some of the warranties back or the coverage that we need if something doesn't work. Usually with some of those generic, or with the name brands, I should say, there is some rebates there. But the thing about those rebates is they usually don't come till later in the year, maybe even 12 months after the year. So you're going to finance that whole thing, whether you get that rebate or not. So that's why I don't necessarily count that. And so when it comes down to this, for this operation, for a 1,000-acre operation, you're going to be financing about $70,000. It's going to take $70,000 to basically book all your inputs or pay for your inputs. And so if you want to figure, if you're going to go to your bank or use your line of credit wherever you're at, and that's 8% interest, I'm just throwing that out there right now. It's kind of an average to where things are at, I think, and maybe it's more, maybe it's less, depending on your situation. But for 8% interest to carry that basically for 12 months, you're looking at about $5,800 in just interest for $70,000 on your line of credit. So obviously you can save $5,800 and you can use that money elsewhere in your operation. That is real savings. We know that. We can use that for something else. Heck, $5,800 would buy a pretty decent little four-wheeler or something else that you might need on your operation. So we can definitely use that money elsewhere. So it's good to know what that savings is. And so it's good to know that in more operating funds. Another pro here, I would say, is if you're using a John Deere Financial like that and you're not using your line of credit, there's more operating funds on your line of credit available for other expenses as they go throughout the year. So maybe your overall line of credit limit doesn't need to be as high, or there's just more funds available for different expenses that just, as we all know, come up throughout the year. So those are the couple pros that I came up with. Maybe there's more, but that's really the ones that I came up with. Honestly, I've got more cons here. That's why I'm talking about this. So as we get into these cons here, I want to talk about just overall, it's confusing and hard to manage. Now, what do I say when it's confusing and hard to manage? Well, I'd say from a cash flow standpoint, it's hard to manage. Say you're using your line of credit to pay for inputs either way. So you're going to use that line of credit either now or you're going to use it later. As in, you're going to book those inputs now. Say I put that $70,000 down on my line of credit now. So that money's going to leave. And so then that's money that's on my line of credit that I'm paying interest on that I just talked about. Well, okay, if I don't use my line of credit, say I use John Deere Financial, some sort of other financing option, I'm probably going to use my line of credit to pay that down the road later on. And so either way, I'm using my line of credit. So it's going to be hard to manage. So you're either paying now or you're paying later. So it just makes it really kind of hard to manage that overall. So the other thing that makes it hard to manage is your balance sheet. And to kind of give a little bit of a refresher here, when it comes to the balance sheet, the way that I see that and the way that I perceive that it's called a balance sheet is whenever you look at that, everything should balance. So if you've got this liability, okay, say you use your line of credit or even John Deere Financial, either way, you got a liability to where you're borrowing money to buy your input. You're borrowing money to buy your input. And so that's a liability that gets entered in for $70,000 in this case, plus interest if you're using your line of credit. But either way, that's a liability that gets entered in. Well, on the same side of things, on your asset side, you're going to have basically a prepaid expense. Or as you go throughout the year, that's going to be an investment in crop. You can change that to investment crop as you basically apply these products. But as of now, it's going to be prepaid expense. So you're going to have something that basically balances that out. And so we're going to keep track of that. Well, if all of a sudden we've got money that goes out to secure these prices, these best discount prices on these inputs, but then it all gets financed or part of it gets financed through John Deere Financial. So some of that gets back into the account. So it's going to change your cash account balance, your line of credit balance, and then it's going to change. It's just really hard to manage from a balance sheet perspective to keep track of those assets and the liabilities because they all need to be accounted for. We all need to keep track of that. So the other thing that I would say here when it comes to con with using some of these different financing options is it can kind of create some bad habits. It can be something that if we're not extremely diligent with and let manage at a high level, this can create a bad habit. And what I mean by that is, so right now as it sits, whatever your line of credit balance is or whatever your cash account balance is that you're using to secure these inputs. So right now you have the money and say your account is at 100,000 and that's it. Maybe your line of credit is at 100,000. Okay. So we're going to use 70,000 of that basically to secure these inputs. So your line of credit balance is going to go to 170,000. Your loan at the bank, your line of credit balance is 170,000. Okay. Well, let's go ahead and finance that on John Deere Financial. So let's bring that money back in our account. So it's going to go back down to 100,000 if you finance it all. In our eyes, like I said before, more room to go spend money on our funds on operating expenses or whatever. But it also can be deceiving because it makes it feel like we've got 70,000 more in our account, even though we got that liability somewhere else. That liability is still somewhere else. We're still going to have to pay that off down the road. But in our eyes, it's like, okay, we got more money now. We can go spend that on whatever, maybe stuff that's not necessary. Versus before, this money went towards a necessary input. Now you have the money. So now you're thinking, well, can I go spend this on something else? And so this kind of can create a very bad habit if we're not diligent about this. And so this is something that we definitely need to keep in mind if we're not used to operating at a high level. And so at the end of the day, it's not necessarily going to do what it's supposed to do if you're ultimately going to spend that 70,000 elsewhere on maybe some repairs that you didn't necessarily need to do or some improvements on the farm that you didn't need to do. And so all of a sudden that 70,000 that's going to be used to pay back this liability to John Deere Financial down the road is spent elsewhere. And so you get to paying that back and all of a sudden you're getting actually closer to maxing out your line of credit because you didn't account for that. That goes back to managing your cash flow. It's hard to manage and this creates some bad habits if we're not used to this. So that is definitely a big con there that I want you to keep in mind and to reconsider. The next one here is another con that I see is this can be an accounting nightmare. And I speak from experience with this, and I'm not necessarily the accountant or the one that keeps track of the books on our end. My wife does most of that, but I've had her come to me and she's like, what is this? Why are all these transactions coming through? Or why did this get put back in our account? And every time that money leaves the account, we got to account for this. We got to make sure we know what that's for, where that's going to. Maybe $70,000 left, but you only could finance 60. So some of that came back. And it's just so hard to keep track of that. And especially from an accountant standpoint, you need to keep track of interest because interest is a tax deductible expense. And so you need to keep track of how much of that is actually interest. Maybe throughout part of the year, like I said, maybe you had 0% financing for 6 months, but then after 6 months, you had 3%. And that was maybe 3 months of that was 3%. And so to keep track of what is actually interest, what is actually principal when we're paying this off. It can be very hard to keep track of all this versus maybe the option of just financing this using your line of credit. That money leaves your account and you can clearly see what the interest is when you get that report back from your bank every month. You can clearly see what's actually interest. So that might be something to reconsider there. From an accountant standpoint, it's a lot easier to maybe just put that on the line of credit versus trying to run that all through John Deere Financials, doubling your transactions, not exactly sure what your actual interest is. So one thing to definitely keep in mind there when it comes to those different financing options. Now, the one thing I also want to say here is this is the same thought process for credit cards. And so I've been talking about using line of credit for buying inputs. Well, we do this as well with credit cards, the same thing. We do this and it happens all the time where we use credit cards to maybe cover an emergency or a shortfall, especially maybe for an operation that's a little bit different than farming. Maybe you're just a strict business and you've got credit cards versus a line of credit to help basically secure that credit throughout the month by month basis as you need it. Well, this is the same thing. Maybe we use a line of credit, plus we got 2 other credit cards that we use from time to time if we need to for an emergency. Well, a lot of people use credit cards for points or cash back because that we can save money there. Well, yes, that's great, but at the end of the day, we still have to manage that. And those are easy to forget about. And the one thing about credit cards, as you know, is those are extremely high interest if you do not pay those back like they're supposed to. And so that's one thing that's really easy to forget about and hard to keep track of. And so that's one thing I wouldn't necessarily recommend if you have the capability and if you've got the option of using, say, just a strict line of credit. It makes it a lot easier. And the one thing there about setting up a line of credit, kind of a side note there, is in most cases, if a guy can set up a line of credit so that way it's sweeps to your bank account. So a sweep basically means it's a revolving line of credit, or whenever you have money that comes down, it's going to go straight to paying down your line of credit, which is going to keep your line of credit down as low as you can. And so that way you're not paying as much interest on it versus basically whenever you're trying to just pay these credit cards down monthly or whenever you feel like you have enough money to pay that down. And so there's definitely some benefits there to just running a revolving line of credit. An operating line basically for your operating expenses is what we're talking about here. So kind of some thoughts to sum this up a little bit. I think this is something that we need to keep in mind and to remember this right here. And it's kind of long, so I'll repeat it when I'm done. But the points on a credit card or interest saved with 0% financing offers at the end of the day are not going to save you more than what the disorganization is costing you. So like I said, I'm going to repeat that. The points on a credit card or interest saved on 0% financing at the end of the day are not going to save you more than what the disorganization is costing you. It's costing you to be disorganized. And we know this because a lot of the challenges that we face ultimately come from being disorganized. I don't know about you, but I can look back in my past and some of the challenges and some of the, I'd say almost mistakes or regret of the decisions that we made sometimes came from just being strictly disorganized. And I think you could probably think back to your operation and maybe your past and some of the things that happened in the past, maybe some of the decisions that were made because you were not fully organized. And so being disorganized at the end of the day is going to cost you. So that's why I want you to definitely keep this in mind. I'm not saying don't go ahead and use these different options that are out there, but you got to think of this in maybe a tiered sort of thing and like different levels of management and where you're currently at. And you need to be honest about this when you're looking at this. Be honest as to where you're at. Maybe you're starting at a lower level and you're just trying to get organized with things. You're just trying to honestly survive. Maybe you're in a really difficult situation, or maybe you've bumped up. You started to get organized with things, but you're still struggling to learn what's going to work, what systems and processes are going to work with your operation. Or maybe you're at an extremely high level. Maybe you've got everything dialed in. This is where maybe you can take advantage of those different financing options to save that $5,800 on interest, like I mentioned before in that earlier example. So you've got to really think about what is your level of management and where are you at? Because these different options that are out there, they definitely have their advantages, but it takes a high level of management to really stay on top of them and to stay organized. And so at the end of the day, the one thing I want to say here is through Pioneer Farmer, I am equipping farmers, ranchers, and ag business owners with essential tools to help them stay organized and to be clear and confident with their decision making. So if this interests you or you feel like you want to get to that high level of management so that you can maybe take advantage of these things, or maybe you just want to talk about how you can stay on top of things and stay organized with your current situation, feel free to reach out and I'd love to have that conversation. So as we wrap this up, I want to say here, at the end of the day, we need to ask ourselves, is this decision, getting finances elsewhere, essentially, serving me and my business? So I'll kind of repeat this. When it comes to some of these decisions and how we go about processing whether we should do this, we need to ask ourselves, is this decision, getting financing elsewhere, in this case, serving me and my business? So I think that's something we can ask ourselves when it comes to these different situations. Is this going to serve me and my business? And you need to answer that for yourself. I cannot answer that for you, but I can help you try to stay organized so we can make clear, confident decisions. So that's all I got for this one, and we will catch you next time. Thanks for tagging along with me today as we sharpened our mindsets. If you've gained insight from today's episode, be sure to take a screenshot to share or send this episode to somebody who might also find value in it. For more, follow me on Instagram @GarrettRuskamp or on Facebook, and join me next time for more conviction through clarity.